So it is official. Shift has merged with CarLotz. But even though the merger is great and all, what does this mean for the company moving forward? Will they still have the funds needed to get to profitability? What will CarLotz bring to the table? In this video, I will answer several of these questions. And if there are any other questions you have, feel free to leave them in the comments down below. But I don't want to waste your time, so let's go ahead and dive right in. Now, this merger was first mentioned in their Q2 earnings report on August 9th. And I think the first question people were asking is why merge with another company who had a small market cap in a relatively similar business? I mean, both of these companies aren't profitable. When we look at their operations, it appears that the merger will be synergistic, because while Shift runs a service that includes the purchase, maintenance, and selling of those vehicles along with their online platform, CarLotz's business model as a consignment business is more focused on connecting sellers to the retail buyers. Now, we will have to wait a couple of quarters to see how strong the synergy actually is. But not only does the combined company get both business models, they also get to use these business models in new locations. Shift has always wanted to expand to the East Coast because there is a huge market there. But the biggest issue was the amount of operational expenses needed to run a hub on the other side of their headquarters, and they've already reduced their hubs to 3. CarLotz will also have the ability to use their business model on the West Coast, and that gives Shift an omni-channel business. But that is not the only thing that benefits both of these companies. What we need to remember is that the used car e-commerce sector has razor-thin margins, so it is difficult for companies to get to profitability, and Carvana has shown how difficult this sector actually is. Their strategy was to try to expand as quickly as possible, but because of the slowdown in demand, they are now in a position where their gross profits are much lower. They also overbuilt, and this led them to have a high amount of fixed costs. And right after I made a video sharing how bad Carvana's business looked, the stock fell 40%. So despite Carvana being the #1 player in the used car e-commerce space, they have a lot of issues, and they really haven't proven that their current business model could truly lead them to profitability. Before the merger, Shift was expected to be profitable in 2025, and they simply did not have the cash to get themselves to profitability. So not only did the combined company need the cash to get them to the point of becoming profitable, but cost reductions are key when we talk about gross profits per unit, which is one of the most important metrics in this sector. They have reported that Shift will cut $80 million of annualized costs from their new strategy. They have cut over 60% of their frontline roles and corporate positions. They've also moved to an online approach for their Shift segment and are focusing on value vehicles to ramp up GPU. In this economy, profitability is most important. And so even though their revenue numbers did decline, the moves that they are making put them in a position to get through this low demand environment. And for CarLotz, they will have massive cost reductions because of Shift's online technology, which is much more advanced. And this means that you won't need as many people on your staff to value vehicles. Shift has a great product with their online technology that they've already stated will be their main source for generating sales for the rest of the year. But they really needed an increase in their inventory, and that is something that CarLotz can bring them because of their connections with corporate vehicle suppliers and their current physical locations. When we look at Shift merging with CarLotz, the change in their business led them to reduce their revenue numbers drastically. In the previous video, I shared that the back half of the year they are projected to have between $220 million and $240 million in revenue, which is much different from the $376 million in revenue that they had at the back half of last year. But the new business plan, which is expected to be fully funded to profitability, is one of the things that is keeping some investors in this company. And this is the reason why I think that they are reducing the amount of vehicles that they are selling, therefore reducing revenue. Because they are a cash losing company, they want to reduce the amount of cars sold so they can preserve more cash to fund them through profitability. With all that said, I need to specify that the CEO, Jeff Clements, did mention the need to evaluate the business after the merge to make sure that there isn't a need for financing or dilution. Their models have shown Shift has the cash to get to profitability, and they have proved to execute on reducing expenses and improving gross profits. But there is still the possibility for dilution if they don't get to cut as much expenses as expected. So keep that in mind. In terms of when each business will become profitable, here are the most recent statements. With their shift to the online presence, even though they have reduced revenues, they have preserved more cash, which helped them get through the merger. And with the new business model, the combined company is projecting positive unit economics in 2023 and company-wide profitability in 2024. However, the car lots business alone is expected to be break even in 2023. Now, I'm sure that many people are asking, with everything going on with Carvana, what makes me confident that Shift won't go bankrupt? Well, it's based off of a couple of things. First, the new CEO, Jeff Clements, led the team for Walmart.com. So with the success he had for one of the largest companies in the world, why would he become CEO of the company in September if there was a tremendous risk of the company going bankrupt? Don't get me wrong, I still think that there is a risk of bankruptcy, but you wouldn't want to become the CEO of a company that has a high likelihood of going under. I think him at the helm puts the company in the best position not only to succeed on revenues, but to generate solid profits as well. Secondly, they did a tremendous job adjusting to the market shift. Their path to profitability is not only clear, but looks attainable. And here's how they will do it. First, they are focusing on lower volumes and shifting more to their online channel. With car lots already close to being profitable, plus Shift's online checkout, they won't need as many transactions to achieve the profitability that they are looking for. Second, they have placed their attention on high margin units. So instead of selling a bunch of cars to achieve profitability like other companies in this space, they can focus on the cars that will give them the best gross profits per unit. They do this by switching to value vehicles, which are cars 8 years and older or have over 80,000 miles. We've seen used car prices go up significantly, so people can't afford some of the newer vehicles. Plus, financing is much more expensive, which means that the older cars are going to be much more appealing than the newer cars. For a company like Carvana, they typically have a good amount of vehicles 1 to 4 years old in their inventory. So we will see if they can maintain their units sold despite all the changes we have seen in the macro economy. The third way to help Shift get to profitability is automating much of their operations. They have temporarily eliminated in-person test drives and have focused on the online checkout channel, which could reduce about 40% selling costs per unit, once again driving margins up. The last way is through reducing their marketing expense and overhead costs. These reductions are going to put the company in a position where they can reduce cash burn while still being able to grow their customer base. So even though their guidance for the rest of the year is not good, I think that the preservation of cash is much more important if the combined company wants to stay on their new projections. And because of the reduction in cash burn, the team at Shift expected to have a combined cash position of about $125 million, which will enable them to fully fund their updated business plan. Now, I want to mention the news of Shift registering up to almost 35 million shares of Class A common stock. Some may look at this and think they are needing to dilute shareholders in order to raise capital, and this is just not the case. These shares are associated with Shift's equity compensation plan and car lot stock incentive plans. So please make sure that you do your own research so you can be up to date with everything going on with Shift. In terms of the merger itself, here's what happened. Carlot shareholders received about 0.705 shares of Shift common stock, or approximately 84.4 million shares. This means that the combined company now has 170 million shares outstanding, which for a company like Shift that already has a significantly low market cap is insane in my opinion. But this is why I have said in previous videos that I do believe the company will have a reverse stock split of 10-1, so they can get back over that $1 amount to stay compliant with NASDAQ standards. The new board consists of 5 Shift board members, 3 Carlots members, 1 mutually agreed, and then Jeff Clement. And if you are interested in looking at the board, go to the SEC filings and you will be able to see the changes that have been made. But the one thing that I want to mention is their valuation. Shift is already priced for bankruptcy as they currently have a market cap under $30 million. When we look at a company like Carvana, it is valued much higher at about $800 million. And in previous videos, I have said that a company's valuation plays a huge role in how risky the stock actually is. If these companies were 5 times what they are valued at, there is a much greater risk that they would go down given the issues that they are facing. But when I look at the valuations right now, which company is more likely to fall in price? The company with a $30 million valuation or the company with an $800 million valuation if both of them have extremely high amounts of debt and have the risk of bankruptcy? I still think Carvana could go down significantly more, but it will be much more difficult to bring down Shift unless they go under. Now, I recognize that this continues to be a risky play when you consider the fact that they are unprofitable and they have just under $200 million in debt. And that is a major reason why it is one of my smallest positions in my portfolio. I've already built out my position to where I want it to be. So I'm now looking for large caps to put in my portfolio, which if you haven't seen my recent video, I share 4 tips for building out a portfolio. Hope y'all enjoyed this video and I'll see you in the next one.